Welcome to KNN. KNN is brought to you by Bob Knakal, Chairman of New York Investment Sales at JLL.
Bob, with everything we've talked about so far, is there anything that's somewhat positive that's come out of this legislation for owners?
Well, sure, Hags. There are ways to creatively create value in the buildings. I think that an owner of a rent-stabilized building today has to be more of a developer than an investor. You have to really roll up your sleeves and develop your apartments. You can still get increased rents by combining units, by popping up and duplexing to a penthouse addition on the roof of the building, or popping down and duplexing with a lower level space. But it requires a lot of creativity, a lot of elbow grease. It's thought that if you combine a free market unit with a previously stabilized unit, that new combined unit will be stabilized, but it will be stabilized at a new first rent or a new free market rent level, but you will be stabilized. But there are ways to enhance the performance of a building. Unfortunately, buildings that are predominantly rent regulated or all rent regulated will probably see their income levels drop year after year, because the rent is not going to go up commensurate with inflation. And certainly real estate taxes will continue to go up, water and sewer will continue to go up. The burdens on owners to rectify things, to meet code, those will continue to escalate. So it will become more expensive to run the buildings, and the income won't keep up with them. So in the future, buildings that are all regulated are very likely to see net incomes going down year over year as opposed to up year over year, which is not a good thing.
With that being said, that will undoubtedly affect buildings' value moving forward.
Well, interestingly, as you know, in the multifamily sector, we've always had the lowest cap rates of any property type in the city. And the reason that the cap rates were always so low was that rents were artificially low based on rent regulation. But there were ways to extract that upside potential, so investors were willing to start with a lower return, knowing that over years and years they'll be able to get those returns up based on doing these different things. Well, now those different things are no longer available to them, so theoretically they have to start with a higher cap rate to make up for the fact that you're not going to be able to push rents the way they have previously. So as cap rates go up, value will drop. And so right now, we're at a point in the market where we have several transactions on the market. We're going through price discovery right now. As of the filming, we haven't seen any contracts signed on anything under the new regime of the laws. Mm-hmm. So we're in that price discovery mode, trying to figure out what the impact is going to be on values moving forward.
We talked about the effect now on value. That also goes in hand with the financing market. What do you think is going to happen there?
Right. Well, it has to. The economics and the way these buildings are being operated has fundamentally changed. It has to impact the way banks are going to look at these assets. To the extent that value is impacted, banks will have to take that into consideration. There's also the thought that regulators may exert some pressure on banks to recalibrate what they're doing based on 3 months ago, the loan to value ratio on their portfolio is different than it probably is today. So how is that going to impact the way the banks operate? But it still is a very solid cash flow stream. It's very secure. It's in terms of its credit rating, it's very solid, particularly for the units that are well below market. So we'll see. We'll see what happens with the financing market, but that's going to be a big part of how things are moving forward.
Bob, when we have policy changes like this, one of the things you always talk about are the unintended consequences that come out as a result of this. What are some of those consequences now with this new regulation?
No, there are numerous unintended consequences. First of which, I think the folks who drafted these policies wanted to create more affordable units for New Yorkers. I think just the opposite is going to occur, because the majority of owners that we've spoken to have said that if they have a unit that has a a current stabilized rent of $1,200 a month and the unit is worth $7,000 a month on the open market, they're not going to, if a tenant leaves, they're not going to do a little bit of $15,000 worth of renovation and put it back on the market at $1,283 a month. They're just not going to do that. They're nailing those doors shut. So effectively, there is no new affordable units being created for anyone. So we're going to have an impact
Or
where
preserved, really. There's no preservation. It's not new. Right?
Yeah, there's no preservation of those units. Those units will probably be taken off the market, further reducing the supply of available units, which is actually going to exert upward pressure on free market rents because someone looking for a free market apartment has less choices now. So that's an unintended consequence. No new affordable units and higher rents on the fair market units. And then also, because these units are not going to be renovated, there are thousands of laborers that have been let go that are probably out looking for work now. So unemployment within that sector of the market is very, very significant, and I don't think anybody thought that that would be the case, but it is a real thing. And if you talk to those folks that have been let go, they're feeling it firsthand.
Bob, what else are owners saying to you about how they plan to operate under this new regulation moving forward and how it will affect the way that they operate the investments in their portfolio?
There's a number of changes with the way these buildings are going to be operated. For instance, if you're an owner of a multifamily building, you have a stabilized unit, and you know that your tenant is illegally subletting that unit, you have no incentive to start any litigation to get possession of that unit, because all you're going to be able to do is get a very small increase in the rent. So you're not going to go after the illegal sublets or the non-primary cases, because it doesn't make sense to invest the money on legal fees to get possession, to get that extra $83 or $89 a month. So that won't occur. Similarly, if an owner knows that a tenant is renting out their unit as an Airbnb unit, there's no incentive to stop the Airbnb utilization there, because the benefit of getting somebody out just doesn't exist anymore.